If you've ever stared at a chart and thought, I feel like it's going to pump, or I have a bad feeling, I should close now, then this video is for you. Because trading doesn't reward feelings, it rewards process. You don't need to be right every time, you just need to be systematically right over many trades. In this video, we'll break down what that actually means, why your natural psychology is not built for markets, what a real trading process looks like, a simple example strategy using EMA 20 and reversal candles, and how to start thinking like a professional, not a gambler. By the end, you'll have a clear roadmap to turn your trading from, I hope this works, into, this is just trade number 47 in my system. Let's start with a hard truth. Your brain is not designed for trading. When price drops, your instinct is to hold and hope. I'll wait until it comes back. I don't want to realize the loss. When price moons, your instinct is to chase. I'm going to miss it. I have to buy now. The market is basically a machine that punishes FOMO revenge trading, hoping and praying instead of cutting losers. And it quietly rewards small controlled losses, boring, repeatable decisions. Following rules when your emotions hate those rules. That's why trading by feel almost always ends the same way. A few lucky wins, then a big blow-up. The only way to survive long-term is to put a process between you and your emotions. So what does it mean to treat trading as a process? Think of every trade as just one experiment in a long series. Your goal is not, be right on this trade. Your goal is, execute my system correctly 100 times. A process means you can answer questions like, why did I enter this trade? Where did I plan to get out before I clicked buy? How much of my account was I risking exactly? Did I follow my rules or did I freestyle? Without a process, every trade is a random story. You can't tell if your wins are luck or skill. You also can't improve, because there is nothing stable to improve. Once you write down a process, trading becomes less about ego and more about running a small personal business. Let's break a trading process into simple stages. You can think of it as a pipeline. Choose your market and time frame. Spot a setup when the chart is interesting. Wait for an entry signal, the actual trigger. Decide position size and risk. Manage the trade while it's open exit, either stop loss or take profit, review and journal. Most people only think about step 3, where do I enter? But professionals care about the whole pipeline. They trade only specific markets and time frames. They know exactly what a valid setup looks like. They risk the same percentage on each trade, and they review their trades like a coach reviewing a game. Now let's zoom into the core parts: setup, entry, stop loss, and exit. First, setup and entry are not the same thing. A setup is like saying, hey, the market is entering my hunting zone. Pay attention. Examples of setups. Price is near a strong support or resistance. Price pulls back to EMA 20 in an uptrend. RSI is oversold within a bullish trend. But you still don't click buy yet. The entry is your specific trigger, like a bullish engulfing candle at support, a hammer rejecting a key level, price closing back above EMA 20 after the pullback. This separation is powerful. It stops you from jumping into everything that looks interesting. You only act when both conditions are true. The market is in your zone. Your entry signal appears. Next, stop loss and risk per trade. If you don't define these, the market will define them for you, and the market is not kind. A professional trader decides in advance, I will risk 0.5% to 1% of my account per trade. My stop loss goes under the recent swing low or under the signal candle. I will never move my stop further away just because I feel uncomfortable. Then they size the position based on that stop distance. This is how you survive losing streaks. Losing 3 trades in a row at 1% risk is annoying, but manageable. Blowing 30% of your account on one emotional trade is how careers end. Remember, your first job is not to make money. Your first job is to stay in the game. Let's put this together with a simple example strategy. Trend pullback with EMA 20 and reversal candles. Rules might look like this. Market and time frame BTC/USDT on the 4-hour chart. Setup, price is above EMA 20 and EMA 20 is sloping up pullback. Price dips back to touch or slightly pierce EMA 20. Entry, a bullish engulfing or hammer candle appears at EMA 20. Stop loss, below the low of the signal candle or the recent swing low, take profit at 2R or at the next resistance or using a trailing stop. Notice what we are not doing. We're not guessing tops and bottoms. We're not entering because it looks like it might pump. We're saying, if and only if the market gives me this exact pattern in this context, I enter. Otherwise, I do nothing. That's process. How do you know if your process actually works? You measure it. First, define R. R is the amount you risk per trade. If your account is $10,000 and you risk 1% per trade, then 1R equals $100. If you lose a trade, that's minus 1R. If you win at 2-to-1, that's plus 2R. Now, after 50 or 100 trades, look at your stats. What's your win rate? Maybe 45%? What's your average win in R? Maybe plus 2R. What's your average loss? Usually minus 1R. From there, you can estimate expectancy, your average R per trade. The magic is this. You don't need a 70% win rate. A system with 40 to 50% wins but 2R or 3R winners can be very profitable as long as you stick to it. That's why process and statistics beat gut feeling over time. At some point, you have to choose. Do you want to feel like a hero, calling tops and bottoms, or do you want to be a professional, quietly executing a system? Heroes. Go all in on sure things, have huge emotional swings, post big wins, hide big losses. Professionals risk small, consistent amounts, take boring, repeatable trades, judge themselves on process, not single outcomes. You will break your rules sometimes. You'll revenge trade, you'll FOMO in. It happens. The key is to catch it, write it down, and adjust your process. Over time, you make fewer emotional mistakes and the system runs smoother. That's how you build a trading career, not just a lucky streak. Let's wrap this up with some concrete next steps you can take today. Write down your current trading process. Even if it's messy, put it on paper or into Notion. Define your core pieces, markets and time frames. Set up conditions, entry triggers, stop loss and risk per trade. Exit rules, backtest, or forward test at least 50 trades. Don't change the rules every 5 trades. Give the system a chance. Track your results in R, win rate, and expectancy. Your goal is not to be right on the next trade. Your goal is to become the kind of trader who follows a robust process. Treat trading like a real job with systems and procedures. And over time, the market will start treating you like someone who deserves to get paid. If you found this helpful, hit like, subscribe, and let me know in the comments. What part of your trading process do you need to fix first?